going to keep this short. Hello, everybody. Welcome. I'm Bonnie Halper. I write the weekly Startup One Step newsletter. I have the link in the chat. And every 2 weeks, we host one investor in a small self-selecting group of entrepreneurs. And we always look forward to the investors' insights. Everybody has different insights. And I want to thank Joseph for hosting us. Joseph, you want to introduce yourself?
Sure thing, Bonnie. We'll go very quick because I know we're limited. Joseph Katz, New York City area. I help startups with go-to-market planning and strategy. So we'll leave it at that and put more in the chat.
Cool.
Nihal, always good to see you. And tell us about you and the fund and what you're up to these days and what you're looking at these days.
Yeah. Well, we just launched Fund 6 last year. So to give a quick background, I was an entrepreneur first with my two co-founders. We built a bunch of startups in the early 2000s. Majority of those startups failed, I would say. So I built 5 startups. 3 of those failed. That's where we got, a lot of our scar tissue and muscle memory for building startups. And that's how we fell in love with the earliest stage of the startup journey, the 0 to 1 phase. Then off some of the successes, started angel investing, and decided to do it together as a fund. Fund 1 was huge. It was the biggest fund ever on planet Earth. It was $1.6 million in 2010. That's now smaller than the average check that we write, for one investment in a company. But that was our entire fund in 2010. We were doing kind of 25K checks, and we treated it like a real fund. So half the fund was for follow-on and half the fund was for initial investments. And it was a hobby, it was a nights and weekend hobby. We weren't paying ourselves. They say when you make your hobbies, if you can make your hobbies your full-time job, then that's the first part of living the dream. And so I'd say now we're living the dream. Many years later. But Fund 2 was a little bit bigger. We raised from family offices. Fund 3 actually went on full time. So that was 11 years ago in 2014. And anyway, fast forward today to Fund 6, 160 million. So it's 100x bigger than our first fund. And what we've done hasn't changed that much except for the check size. We're the first check-in, we're the first investment into founders' companies, pre-product market fit. So we're investing and then helping the companies raise their Series A. We are generalists, so we invest in consumer and B2B. But I do say, writing a check is like less than 1% of what we do. Our job is really that of kind of a therapist, and a psychologist. We're constantly assessing kind of founders' chips on their shoulder, seeing if they have what it takes, to build what they want to build. And then what we try to do is anytime a founder takes 30 minutes to pitch us, we work really hard to provide some sort of game-changing introduction to help them on their way. And that was inspired by our founder journeys, where a lot of investors would actually, the bar is pretty low. Like most investors just don't even respond. When they're not interested, right? They just ghost founders. But a lot of them, when they pass, that's it. I think what we realized is that life is very long and that most founders will go on to build multiple businesses in their careers. And if we can just be super helpful and actually without any quid pro quo, without asking for anything in return, just, thanks for presenting your business. Like, I think the CMO of Ford Motor Company might be really excited to learn about what you're doing. And it's kind of like a game of memory where we connect the dots. And I say it's a triple win. CMO of Ford is happy to bring innovation into their company. The founder's blown away, like I say, the KPIs, they're calling their mom or their grandma, like when they leave a meeting saying, oh my God, like this is a dream customer. And now I have the chance to pitch them. And for us, it gives us a chance of like kind of free diligence. Ford is going to really like this company. And they get back to us and to say this, listen, we looked at 20 of these companies in the space, and this is by far the biggest opportunity, and we're ready to spend a lot of money. Then that's really interesting signal for us. So anyway, that's what we try to do with every founder we meet. And once in a blue moon, or actually once in a full moon, I would say once a month, the stars align and we end up doing a deal and we end up writing a check into a new company. So we average about one a month. Um, but 90% of the time it doesn't work out for a multitude of reasons, but we still want to be super helpful and let the founder on their way. Now, what we've seen in 16 years of doing that is that um, the founder will have such a great experience kind of the first time around, even if we didn't invest. The next time they start a business, we're their first call. And by the way, the next time it might be a fit. Um, or that person's sister or brother or friend or cousin is starting a company and they ask who they should go to, and we get that referral. So yeah, I think the theme, what I've learned at least in 16 years is if you give to the universe, it will give back to you 100 times over. Especially if you give to the universe without asking for something in return, without being transactional. Um, you pay it forward, and in some industries, especially venture capital, um, karma means a lot because it's a people business. Um, and so anyway, that's how we built the firm. We got 12 people in Soho. We've been lucky to be on some pretty awesome rides like Uber, Admob, Attentive, Alloy, Brightwheel, Ghost, and a lot more coming. You can go to eniac.vc to check out our companies. And yeah, I'm here to help. If any of you are building a company, you heard my spiel, so I owe you one game-changing introduction at the very least.
So,
So thanks for having me, Bonnie.
so I went to wish you a belated happy birthday
Thanks.
and wanted to ask if you want to share your contact information with the group.
Of course. I'll put it in the chat.
Okay, thank you. And you guys should reference that you met Nihal here at the breakfast, so he knows. So questions. I know I don't think we really have time to go around the room since your time is so limited today. Right?
Yeah, I'm just putting in my contact info. But yeah, I can do about 15 minutes of questions, and then obviously anything else, email or Twitter.
Okay, thank you. Zarin has a question.
Mhm.
And if you could briefly introduce yourself, Zarin.
Hello, thank you for the insightful, intro. I am based in Switzerland, and I have a finance background, and I work with on business partnerships and development, usually in the finance sector. My question was, you said actually that the only difference from the time that you started till now was the size of the check. But also wanted to say, since there's a big difference from 1 million to the 25,000, did the companies that you look at change? Or more specifically, should very early founders target certain funds, and when they grow a bit bigger, targets other type of funds to increase their chances? Is there a pre-screening that
You keep breaking up.
Yeah. Yeah, I think the question is, in terms of fund size, um, where should founders kind of focus based on what they're raising?
exactly?
And so, yeah, when we started, we were like you said, 25K checks. We were kind of angels. We wouldn't lead rounds. We would just be able to follow on with people that were leading rounds. I think now, we're obviously leading rounds. We want to be the first money in, so we want to be kind of the first 500K to 4 million has been the range in companies. But at the next stage, and that's kind of pre-seed and seed is what we would call ourselves. And then the next stage is the Series A, and that's the 10 to $30 million round. After product market fit has happened, the companies are generating revenue, they're growing very fast. And that's where we kind of run the process to help these companies raise the A. And they could raise the A from any of the firms like Sequoia or Excel, Bessemer, Lightspeed, NEA. These are all firms that we work with that we think highly of at the A. The Series B then is, the next stage. Usually, by the way, for Series A, we're seeing the floor today, especially for AI companies, being around 2 million annualized revenue to kind of be in the range of raising a Series A. The Series B is a little bit more than, I'd say, double that, maybe 5 million as the floor for the Series B. And the Series B could be a $50 million round, for example. We think that the growth, the large $100 million, $200 million rounds now are going to be more few and far between because companies are a lot more efficient thanks to AI. People don't have thousands of employees or need thousands of employees anymore to build a very large company. Some of the largest companies now, like Cursor and Replit in the AI space that are multi-billion dollar valuations, are under 100 people teams. And so because they don't have huge headcounts, they don't need to raise, I think that aggressively like tech companies had to. But anyway, the landscape is changing. It's pretty fluid, but that's kind of how we see it today. We're pre-seed seed, the first 500K to 4 million. Then when a company gets to about 2 million in revenue, we go and try to raise a Series A, which is kind of, 10 to 25 million. Hopefully that's helpful.
Thank you. Yes, thank you.
Okay.
Yeah, well, first and foremost, thank you so much, Nihal, for, being here. Your time is really appreciated. I guess my question here, and just beforehand, I'll just introduce myself. I am the co-founder of Rentworthy. We're a consumer app. We help streamline the entire rental process for rental businesses, and also we offer a app for individuals to directly rent from these rental businesses. So it's very much like DoorDash, but for consumer rentals. Now you mentioned that your firm does invest in consumer apps, I mean consumer companies, but also B2B. I'm curious to hear, how do you do your due diligence when measuring metrics between the two? Like, is there more metrics you look at for consumer companies as opposed to B2B, or are they more or less the same?
Yeah, consumer has very different
Yeah.
kind of KPIs, if it is a subscription model, and so we have a bunch of subscription companies on consumer. One is called OHI. Annualized revenue is still a KPI, but we look at other things like churn and viral coefficient as stronger signals. So, viral coefficient, the K factor above 1, meaning the product is growing organically, and it goes viral without you having to spend additional money. And then the churn, that you kind of want 30, 60, 90-day retention to be, somewhat above 25% at 90 days, in general for consumer apps. So that's, those are other metrics that we definitely look at for consumer. They are very different than B2B.
It sounds like you have a preference for subscriptions are, of course, repeatable business when it comes to consumer products.
Yeah, that's right. I mean, I think, as an investor, well, even as an entrepreneur, it's a much better business in terms of predictable revenue, to have things on subscription, whether it's monthly recurring, like an MRR, if you're an enterprise, or a monthly subscription, as consumer. Otherwise, it's very hard to predict, your cash flow and your business. And so that's why I think we're seeing for consumer, the business models that are sticking are, like Spotify and Netflix, for example, versus, obviously TikTok and Instagram have incredible user bases and incredible ad sales teams. And so that's the monetization channel there. But you do need quite a bit of traffic, obviously, to generate revenue through ads on consumer if you're not charging monthly.
Next question.
Well, I'll just quickly ask, what trends do you see right now, like in your business, that are really uppermost, that are really, important?
Yeah, I think AI is really disrupting every category. It feels like the late 90s of like
Yeah.
.com 1.0 in terms of every business reimagining themselves through AI. And so I think that's probably the most disruptive factor. Like you can give me any business, especially old school businesses like healthcare, insurance, construction, real estate, that are slow to digital transformation and drop AI in, and it has um, huge potential and huge disruptive opportunities. Um, I'll give you some tangible examples. We just closed out a company last week that helps car dealerships um, with more basically maintenance service revenue um, using voice AI. So when you buy a car, you get a warranty, you get some sort of a manual. Most people don't go in for their services at certain mile markers. Most car dealerships don't have the bandwidth to call people to get them scheduled. AI is a great use case for that. And so this AI will call customers, get them scheduled, get them back in for appointments. Car dealership is happy because they generate more revenue. That's their number one source of revenue. Um, and the consumer is happy because their car doesn't break down.
Quick question on that. Are people answering their phones to numbers they don't recognize?
Yeah, so it's a good question. I think some people are. I don't, you probably don't. I think some people are, and also it can come from the car dealership, right? And so if you have caller ID, um, like the car dealership will show up. So that's the outbound experience. Um, you know, Otherwise also the AI can email or use other forms of multimodal communication to get to the user. Um, so that's kind of super interesting. That business started doing, millions in contracted revenue from car dealerships. Here's another voice AI play. This is for non-emergency 311 and 911 call centers. So when you dial 311 in San Francisco, you're on hold for 6 minutes. And it might be a complaint about your neighbor. It might be a complaint about your trash being full. It might be an emergency that accidentally got to 311 instead of 911. And you're on hold for 6 minutes. And when you get through, the call center rep on the other side has very low job satisfaction rate because they're getting yelled at all day long, right? My neighbor's too loud. My neighbor's too loud. When you coming? My neighbor's too loud. Whatever it might be, and so they're not happy either to deal with, the complaint. So this is another great use case for AI because AI can route it in seconds, not 6 minutes. If it's an emergency, God forbid, it goes right to the right place. The ambulances come in. If it's trash, it gets routed to sanitation. If it's neighbor, it gets logged. Um, and so, that's kind of reimagining like the entire call center structure of like, local government emergency lines through AI. So those are two examples. I'll give you a third only because this is why my job's so fun. Every day I get to meet, five founders that just like blow me away with like brand new ideas we never thought of. Um, SEO and SEM is a $60 billion industry a year. But now what's happening to Google search is a lot of people are going to AI search. Like my 10-year-old is starting a chat GPT, right? He's not using Google.com, right? It's just a better search experience. You get um, your answers quicker. There's no ads right now. And you can use Claude, you can use Gemini. Of course, that's Google's own product, Gemini. You can use um, Claude, which is Anthropic. You can use ChatGPT, which is OpenAI, as some of the AI search interfaces. Um, but how do brands influence how they show up on AI search like they do with SEO and SEM? So where would those budgets go? So if I'm BMW and I have a new sports car under $50,000, and I search ChatGPT, what are the best sports cars under $50,000, and BMW doesn't show up, I'm pissed, right? And so this company called Evertune actually will help BMW figure out what is ChatGPT actually training from, and let's actually create more content on those sites. So it turns out that it's Car and Driver, for example. So this company will create an article and send it to Car and Driver, or maybe even buy ads on Car and Driver to increase that search ranking, that AI search ranking for BMW for that search. So that's a new way of looking at SEO, SEM in the AI search world. So those are three examples, but hopefully that gives you kind of some diversity on really, truly how AI is disrupting, like literally every single vertical that we've seen.
That's one of the hottest marketing topics I think you
Yeah.
just mentioned. I talk to people about that once or twice a week myself. It's definitely changing.
Yep. Cool.
We might have time for one more question. Did anybody else?
Yeah, just the follow-up, Nihal, is there
Yes.
have been some questions about profits among many AI companies. I mean, OpenAI themselves lose about 3 billion a year and are not expected to become profitable before 2029, according to their own forecast. So how does that apply to some of the startups that you just mentioned or some of the other ones in the sector?
Yeah. I mean, I would say like as a large company, like Amazon was not profitable for 20 years.
Right.
Because they were investing all their profits into infrastructure. And that's certainly what OpenAI is doing. But in terms of these other companies, like the car dealership companies called Mia, the call center companies called Hyper, the SEO, SEM company for AI search is called Evertune. These companies actually will be like very close to cash flow positive, like much quicker than other startups because their headcount is so small. Again, they don't need large teams anymore because AI is doing so much. Sam Altman from OpenAI has this vision. You'll have a one-person billion-dollar company, and that's happening because you can outsource your code to AI, your marketing to AI, everything else. You kind of just need the core founding team, and so all of these, like these three companies, for example, I don't expect them to be bigger than 20 people by the time they're doing, maybe 10 million in revenue. And so they can certainly be profitable at that time if they want to show profitability. Their biggest bill is probably to OpenAI, you know. And so anyway, it's also it feels like one big Ponzi scheme because they're spending money to OpenAI. OpenAI is creating the revenue to sell them, more products. But at the end of the day, they're definitely feeding off each other. But at the end of the day, the businesses, like the brands and the mom and pops, and the marketers are benefiting, from these better ways to attract and retain their own customers and their own revenue. But yeah, I do think that AI companies will be more profitable than, Web2 companies.
Got it. Thank you. That's really very interesting.
As a writer, I mean, AI is not a solution for everything, and certainly not LLMs. And as a writer, it doesn't know how to tell a story. There's a big difference between where, I work with people who use, ChatGPT, and then they'll send it to me, and I have to straighten everything out. It's an intern. It's not there yet in some verticals and in some cases.
That's right.
So I don't think it can do everything. Yeah, I know you're really short on time, and I'm going to try to ping you to come back when is your slow time of the year? Does such a thing exist?
It doesn't exist. Yeah. Yeah. This time is, it's just a little like your breakfast time is just a little bit of a challenge, but I'm glad I made it happen.
I'm glad you did
This is my
too.
schedule. But yeah, thanks for having me, guys. And my email's there for anybody that needs anything. And Bonnie, congrats on a incredible kind of long standing breakfast.
I know it's been years, but we're always happy to have you back, and thank you.
Awesome. Thanks, guys.
Thanks, everybody.
Thanks.
Bye-bye.
Bye.